Afternoon all. I wanted to talk about the Myfxbook community outlook, and a lot of you are probably familiar with the long versus short ratios. That's fine, and hopefully you're aware of like the static nature. Like for example, the Aussie Swiss, the static nature is that they're 78% short, 22% long, but the dynamic nature is the movement across time. So you'd want to come back in an hour to see how those volumes and positions have changed since. So it's not where we are necessarily now, but where are we going? Where have we come from? Okay, so that's the dynamic nature. So hopefully that's clear. I made quite a lot of videos on that, so hopefully you guys are all right with that. It's basically two sides, two components to the sentiment analysis: where we are now and where have we been in order to project the future. Okay, so if we're more short in an hour, if we're 80% short, then that's going to be confirmation that they're adding to that bias. Okay, so that's hopefully like a prerequisite understanding of the sentiment. And I suppose the next thing on top of that is your average short price, average long price, which is basically telling us where their break even is and how far away they are from their break even. Now you can see as on a lot of these pairs, they're incurring a lot of drawdown. And interestingly enough, they're making quite a bit of money on some things, but that's fine. But on the majority, they should be at a huge loss. Okay, so that would be normal, the CAD Swiss, where they're undergoing losses and they're undergoing losses. So the bears, the short price, they're losing, and the bulls, they're losing. Okay, so what I want to talk about is hopefully you understand, the dynamic and the static nature of the sentiment. You want that to agree over time. And I want to talk about the average short price and the average long price and how we can use that data. And we were using that a little bit in the Discord, and I was talking about gold. So what we can do, we can simply grab that data, right click, copy. That's the average short price. Look how far away prices right now versus their break even, 1831. So come to MetaTrader 4 or TradingView, and what we want to do is insert a line, horizontal line, place it anywhere. We know it's 1831. Double click, right click, horizontal properties, and then we want to paste. Okay, so that's where the bears have got their break even, which is crazy. Okay, and now we want to grab that data. Control C, Trader 4, insert indicators, line, even, horizontal, double click, right click, horizontal properties, paste. And so currently this is just paying the longs. And so really what should happen in speech marks is that we should see price within that parameter and that parameter, because it's unusual for the retail traders to be profiting for all those reasons that I said at the beginning of the video. They're emotional and they're counter trend, and they're at the bottom of the information food chain. And we're basically, as retail traders, we're never really told what's going to happen. The big fish have got visibility and an idea what's going to happen this week, but they're not going to tell us because it's not in their interest to tell us what they're going to do. They might put out some information that they'll put out and then they'll fade it. Basically, they're saying, oh, we're going bearish into the FOMC, but are they really? Or are they actually going to look to buy the dip on the USD? So we're at the bottom of the information food chain. But what should happen, because retail traders are normally wrong, we should see price within those parameters. So we can think of it as a resistance and support. So once we go below, it won't allow the bulls to profit. So you see how we're acting as a decent support, okay? And what it is, it's actually inducing longs, because this is where their break even is. So every time it comes up, it's going to increase their bias. It's going to add to their bias and think, okay, maybe it isn't a bad idea to buy. That's what it might be. That's what we might do. Let's maybe think about buying. And by having this just buoyed above that line, it's going to induce longs. It's going to encourage new bulls in. And by doing so, we'll have price below that level and it will trap them. So this is the trap line. and this is already the trap line, and we'll have to zoom out a long way. And so they short their break even there, right? So that's the trap down here, and they held on. That's their break even, which is scary. So if you're looking for a swing term idea, swing trade idea, is that you could potentially come down to their break even. That's going to take a long while. And for a near term idea is that we should see price below this. And what it's doing is inducing longs, and it's been very naughty and evil. And takeaway, I suppose you can think of it as that the static and the dynamic sentiment needs to agree, and what it needs to do in order for this to fall, it needs to induce more longs. Okay, so that's what it needs to do. And point 2 is that both bulls and bears should be at a loss. And also point 3 is I showed you how to add those levels. And you don't have to do gold. You can do any currency pair, anything's on this particular web page. And you can just simply copy that data. If you're trading pound NOK, I don't know if you are, or Aussie Swiss, just copy and paste and just add onto your chart. So we can think of these as a decent resistance when we go below. And I suppose lastly is that we can think of it a little bit like the order book, and so much is that what we're looking at on the order book, we're looking at current positions. So on your left hand side is the orders where people are going to get stopped out and where they're going to enter via order. And on the right hand side, the histogram on the right hand side is your open positions. And now this open positions on the right hand side of the order book, which is here, right hand side, that's your current positions. These are the orders. So this is essentially what we just drew on gold. These are the current positions. So it's going to act as a resistance because it needs to induce longs. Okay, and that's what it needs to do. And so that's that. So it's quite useful, and you can see, right, when there's a big bulk of sellers who come in, it can act as support. And as you can see, it happened back here on gold, which is horrible. There. And it acted as a support. And so what should happen, we should see price below that, and it's going to act as a resistance. And then we'll be in between those parameters. So if you're looking for a long-term idea, it could come down here. But we have to remember the GOT data is strongly positive for gold. So basically just a quick one there on the sentiment. And it's a little bit medium to advanced analysis because we talked about the static and dynamic nature, and now we're talking about the targets and their break even, because we know it shouldn't allow them to profit. And lastly, on the sheet, on the currency strength sheet, which probably needs renaming, is that we can see the bulls break even and the bears break even, and those highlighted in orange tells us that they're profiting. So euro yen, they're profiting, the bears are making money on the euro yen, so that'd be slightly unusual. Dollar Swiss, the bulls are making just a tiny bit of money on their longs. And I've added gold there as well, so you can just manually type them into your chart, or come here and copy and paste, and that's that. So you can use it as targets, and also hopefully helps with the understanding of the static and dynamic nature. And really what it is just inducing and trapping retail traders, and that's horrible, but that's it. And that you can see how that was the trap, because that's their break even, which is scary, isn't it? And and also lastly, what will happen if price does come up is that this will come up as well, because what it will mean is that these guys are getting ejected out of the market. They're getting stopped out. So the higher up it comes, that's just one of those things. It just tells us that they're getting stopped out, and that's just a physical proof that it's basically engineered to trap and annihilate the retail traders. So below 1918 would be normal, and 1831 we should be above, because we shouldn't be below, because that's where they're sold. Right? And that's that. So hopefully it helps. Hopefully it wasn't too confusing, and you can also use this on your chart for targets as well, which is pretty cool.